Good afternoon. This lesson is going to walk through section 6.5, company cost of capital, and most of 6.6, weighted average cost of capital. So as you might recall, the last lesson we were talking about the value of the firm, and I introduced the Modigliani-Miller formula. So now we have the setup essentially to talk about company cost of capital, and we will be abbreviating this as simply CCC. And what is company cost of capital? Well, it equals the expected rate of return for the firm's entire portfolio of assets. So recall that we were thinking about the firm as a portfolio of assets, or on the other side of the balance sheet, we could think about a portfolio of debt and equity. So this company cost of capital is the expected rate of return on the firm's entire portfolio. And here we'll talk about the liability side, so debt and equity. And so what you could think of alternatively is you could think of the CCC equaling the average return by the firm's investors. Okay, so now for the more explicit formula, the calculation would be essentially a weighted average of the structure, the capital structure. So recall that the company is financed by both debt and equity, or the value of and that equals the value of the firm, right? D plus E. Well, we could take the debt share of the company, multiply it by the rate of return received by debt holders, and then simply add that to what is being received by the equity holders. So that should be pretty straightforward. And so it's a little more on notation. This relationship right here, we'll call this the debt ratio. So debt over total value of the firm is the debt ratio. And then this right here is similarly, we'll call this the equity ratio. Okay. Now thinking about going back to cash flows, of course we get these valuations based by cash flows. So another way you could think about the CCC is the CCC relates to the cash payouts. From all firm securities. And we can see that in this following relationship. So if we can think of all the cash being received by debt holders in period T, and we add the cash being received by all equity holders, the residual, right? The equity holders get the right to the residual cash. Well, that must equal all the cash that's being produced by the assets in that period, plus the interest payments that must be paid. Or sorry, not the interest payments, but the tax savings that we get from the interest payments. So this is your shield, your tax shield, right? So this relates very closely to what we just talked about last Thursday. Notice that the total payouts on all securities are identical to the cash flow of the real assets plus the tax shield, the ITS, interest tax shield. And so recall the Modigliani-Miller formula. We have D plus E equals the value of the assets plus the interest tax shields, right? So if we can assume constant debt and that we pay the same yield to maturity on our debt, that the coupon equal to the coupon, we can have this relationship. Well, if that's the case, we can simply, with a little algebra, we can rewrite CCC as the value of the asset divided by the firm value, multiply that by the rate of return on the assets, and then we can then think about the share, the value, the amount of value that's created by the interest tax shields. Again, divide that by firm value, and multiply that by RD, because recall that we were assuming that the discount rate on the interest tax shield is RD. Right? So this is essentially, on the prior formula, we had weighted the CCC looking at the liability side, right? We looked at the debt share and the equity share relative to the firm value, multiply those by the respective rate of returns. Well, this form of the formula is now looking at the asset side, looking at the real assets plus the value created by the interest tax shields, and again creating the shares and multiplying by the shares by their respective rate of return. Another thing to point out is that the CCC, company cost of capital, cannot be interpreted as OCC. So to make this explicit, company cost of capital does not equal opportunity cost of capital, because this total payout here also looks at interest tax shields, which opportunity cost of capital does not. Okay, but the opportunity cost of real assets, because that's generally what you're looking at when you're looking at OCC, it's the real assets only. You can estimate this looking at this relationship. So I'll clean the tablet here. So we could look at the cash being received by equity holders. I'm just rearranging the formula we had before. Should equal the amount of cash being produced by the real assets. We need to pay the debt holders, and then of course we get our interest tax savings. We think of that for every year T. And then notice that when we think about the rate of return expected, pardon me, there should be a subscript there. The rate of return expected by equity holders should also be related to the returns expected by the other stakeholders. Namely, we could look at the rate of return needed for asset holders, or the rate of return required for the asset. And now, so notice how I'm mapping these between the two formulas. Similarly, we could think about the debt holders, and then we could think about finally the interest tax shields. So all I've done here is relate what we see in the cash portion and relate it to rate of return. So this cash, by definition, equals RE times equity. This cash by assets must equal the rate of return by the assets multiplied by the value of the assets, and same thing down the line. And so I've rearranged this, now dividing through by E to get this second formula. I'm going to do a couple more manipulations. So we have, we're going to call this relationship just simply the debt to equity ratio. That should be pretty self-explanatory, but just in case. Okay, if that's the case, now we're going to substitute for VA using the Modigliani-Miller relationship. So we now have RE equaling, here's the replacement, right? We could rewrite the, using the Modigliani-Miller relationship, I've replaced my value of assets. Okay, and then finally we'll simplify this to just take RA plus, essentially we're going to factor out. You'll see this when we finish the formula. Alright, so this is a simple rearrangement, but in this form, this is called the leverage ratio. And why is it called that? Well, essentially it's looking at the rate of return for equity holders based off of the standard rate of return on those assets, and then adding the extra value with leverage, right? The extent that you get more bang for your buck on leverage is based off of the spread between your rate of return on assets versus what you have to pay to finance those assets in the form of debt, and then you get the added benefit of the interest tax shields. So that's what this formula is showing. Let's do a couple more manipulations to explore this relationship further. If we solve the leverage ratio for all RA, so take the leverage ratio and rearrange it so we can get the rate of return on assets, we'll get this relationship. So RA equals your debt tax affected and multiply that by RD, and then add a similar relationship for equity. And if that looks a little messy, or you're not seeing what's really happening, notice that this bottom term is really the value of assets. So we could simply rewrite this as in this form too, depending on what is more useful for the problem or the kind of the intuition you're looking for. So similar to before, if you're looking at the rate of return for something, generally you see that follow the pattern. You have the rate of return of assets, and then here you have the value of assets being in the denominator, as we had for equity return on equity. So if you look back at your formulas for return on equity, notice we had equity in the denominator in that formula as well. Okay, and as I had pointed out before, we could think of the rate of return on assets as the unlevered return. So we're going to call this the unlevered company cost of capital. And so, to be very clear, that's what we're talking about. Return on assets is the unlevered CCC. Okay, let's try to get this really locked in our heads by looking at problem 3.5b. Okay, so we're supposed to calculate Terrific's company cost of capital and unlevered company cost of capital. Okay, and so Terrific was from the prior problem, so we had that set up there. But so if we want to solve for CCC, there's several forms or several formulas to choose from, but given the information provided in the problem, we're going to go with this form. And now we could just plug in. So recall that the debt was 300. Again, 300. The equity was known through the share price times the number of shares, which is 140 million. Extend that out a little. The rate of return on the debt was 6.4%. And then again, the equity is 6.4 times the 140. We have the same denominator. I guess I'll rewrite it for completeness. And then if we can fit this in, the equity, rate of return on the equity was a little over 7%, and almost in there. That's okay. So 0.0703. That's the rate of return on the equity. If we do that math, we should get a company cost of capital of 0.0687. Okay, so that was the first request on this problem. The second request was to solve for the unlevered CCC. So again, as soon as we hear that term or that phrase, we should immediately think of rate of return on the assets. And given the setup in this problem, I'm going to use this form of the formula. So the share based off of debt, the share based on equity, and again we could just plug in. So our debt was 300. We have a tax rate of 35%. The value of the assets is 1091. Again, the debt was 66.4%. Our equity, I'll just do the straight math here, 896. Again, value of the assets hasn't changed, and the equity was a little over 7%. Okay, if we do this math, we should get 0.0692, and so that is the unlevered CCC, which is equivalent to the rate of return on the existing real assets. So one way to think of this is that the company cost of capital gives the opportunity cost of capital given the firm's existing both real assets and capital structure. So prior to this, this lecture and earlier problems we were evaluating projects, we were generally coming up with discount rates based on the riskiness of those assets. Here, this company cost of capital is based off the rate of return on those assets and also the existing capital structure, so how much debt you have on hand. So given that it involves the company cost of capital structure and existing assets, if you're going to then evaluate, as a firm, you're going to evaluate a new project, it's very important to realize that if this new project is vastly different than the current real assets that you own and operate, then you need to really rethink what discount rate you need to use, because this company cost of capital will be inappropriate. It will not match the specifics of that new asset. If, on the other hand, you're simply extending operations of what you already do, then your company cost of capital would be an appropriate discount rate when you're evaluating a new project. Okay, so let's turn to the last section that will be in this video, the weighted cost of capital, weighted average cost of capital, or the WACC. So this is 6.6. So weighted average cost of capital. And as I was pronouncing it, you might have suspected that this is often abbreviated as WACC. And so what does this do? Well, just to, I guess, refresh your memory of what we just covered, when we think about the unlevered company cost of capital, so unlevered CCC, we have something like this. Now, RD. Okay, and you could do a similar replacement for each of those VAs. You can replace it using the Modigliani-Miller formula with this simple rearrangement. Alright, so there's your D, there's your E, and then your DTC. So Modigliani-Miller relationship. Well, for the weighted average cost of capital, what will be easier to think about, or easier to see it, is we're going to define another ratio. We'll call this, we'll write it as tau D, but this is going to be the debt ratio. Recall that the debt ratio equals the debt over the firm value. And of course, you could also write it as, equals. You could also rewrite the denominator using, again, the Modigliani-Miller relationship as this. Okay? So, what we're going to essentially end up doing is we're going to multiply both sides by VA. So given that value of assets can also be written in this longer phrase, if we multiply this formula, both sides by VA, we can get, this is a bracket, so rewriting VA as this slightly different formula, and multiply that by return on assets. Multiply the right hand side by VA simply gets rid of the fractions. Okay. Now what do we want to do? We'll now divide both sides by the value of the firm. So the value of the firm is D plus E, and so I'll just do this in the same line. Wait for it. This is going to be, quite a bit of build up here, but we're essentially going to be doing a lot of algebra to get a form of the function that we can get some more intuition. Okay, so we've divided by the value of the firm, and essentially what we're going to end up with is on this side we get 1 minus tau, so the debt ratio, times the tax rate, times RA, return on assets, equals tau D, so there's the debt ratio, right? Tau D times 1 minus tax rate RD, plus 1 minus debt ratio times return on equity. And so this right here on the left hand side is what we're going to be calling the WACC, the weighted average cost of capital. And I'll often call this R star. And so now I just rewrite what we had before. So that's a tau. So the debt ratio times 1 minus the tax rate RD plus 1 minus tau D, return on equity. Okay, so what this weighted average cost of capital gives us is it can be used to discount project cash flows instead of the opportunity cost of those real assets, but only under certain assumptions, it'll be most appropriate under certain assumptions, because under those assumptions we will have the correct present value of the assets cash flows plus the present value of the new interest tax shields. Okay, so what are those assumptions that we are looking for? WACC, weighted average cost of capital method. So if you use this for your discounting, this is exact if the following holds. So first, the firm follows a target debt ratio. A fixed debt ratio. So they have an established capital structure that they maintain. Second, it must be the case that the rate of return on the assets is truly the opportunity cost of capital of, I guess, let's say 4, for the assets created by the project. And then finally, we want, or essentially, it must be the case that the project goes for forever, or generates a perpetuity. Okay, so under these assumptions, with the essentially, what do I mean by forever? We can think about this, this new project B. Let's clean that up. The assets from this project B go forever. So from now, one period from now, you'll start getting this cash flow. You can discount it by that rate of return. It goes forever, and then recall our perpetuity formula. We have the cash flow divided by, simply by the return. Okay, what does it mean when you have a target debt ratio policy? Let's think about that a little more. Well, it must be the case. So if the firm fixes debt ratio, so it's always targeting that debt ratio, it must be the case that any new debt issued to finance the project must equal lambda d times the value of the assets created by this new project. And then just from that relationship we had before, lambda d must, since this thing is going forever, we could rewrite the value of the assets produced by project B as simply that. Okay, well, you might be wondering what this lambda d is about. This is new notation. This lambda d is simply relating the target debt ratio, this tau d. So if you have a target debt ratio, it must be the case to maintain that ratio, you will lever up any new assets with this relationship. Okay, so let's look at that. If you are acquiring a new project that generates these new real assets, well, we just seen above, well, it must be the case that we're going to be needing or generating new debt equal to this. Well, we know that with that new debt, we get new value with the interest tax shields, right? So there's the value of the that's created by the project. Let me do some writing here. Similarly, you could think about the value of the perpetuity, right? Finally, so if I missed you or lost you on that step, so what I did was I used the relationship above here. So here we have the value of the new asset, right? If we factor or multiply this out, and then this term is capturing what we had above here. And again, we could do the replacement for lambda, and we have 1 plus tau d over 1 minus tau d tax rate times the tax rate. So I'm just doing the replacement for lambda, and again we have the relationship there. Okay, why am I doing this? We'll get there. A little more algebra, a couple more lines. Okay. Let me just get this down. More rearrangement within the parentheses. And finally, we can write this as the cash from the assets. I'm just gonna, essentially I'm just multiplying out the two formulas, or two terms. Okay. Finally, we get to, then we recognize this bottom term. Well, that bottom term equals our R star. So what have I done? I've essentially proven that if you have an asset that is going on forever, you can value it with a perpetuity. It must be and if you have this fixed debt ratio, it must be the case that you're going to issue this much new debt, right? We established that relationship. We introduced this new term. Well, this new project creates value both by the real assets as well as the new interest tax shields. And then through all these algebra manipulations, we essentially have proven that it's accurate to use WACC, the weighted average cost of capital, to value this project. Okay, let's see this in action by doing problem 3.6. Okay, 3.6. So we have Eddie's Electricity is considering buying a cold fusion generator for $75 million, which will yield yearly net cash flows of $12 million in perpetuity. Eddie's has a market value of $450, pays 8.5% on its debt, and maintains a debt ratio of 60%. Analysis of stock market data reveals that Eddie's share return on average 18%, and Eddie's tax rate is 35%. So first we're supposed to solve for Eddie's weighted average cost of capital. So let's just do R star. Okay, well we know that R star simply equals the target debt ratio, tax affect that, and then multiply that by RD plus 1 minus tau D, rate of return on the equity. Okay, well, conveniently all this information is provided. Our target debt ratio is 60%, the tax rate is 35%, the return on debt is 8.5%, 1 minus the 60%, and then the rate of return on the equity is 18%. Okay, if we do that math, we should get 10.52. Okay, and then secondly on this question, we're asked to find the value of this cold fusion generator project. Well, given that we have a fixed target debt ratio, and given that this project is going to go on in perpetuity, we can use this relationship to solve for NPV. So all we have to simply do is take the cash flows and divide it by the weighted average cost of capital. But of course, for the NPV, we also need to subtract out the initial investment cost, right? So we're told we get net cash flows of 12 million each year. We can divide by the weighted average cost of capital we just calculated. The initial cost was going to be 75, we're told. And so if we do this math, we get NPV of 39.123. Alright, so that will conclude this video, and we'll pick up next lecture talking more about betas and factor models.